Good morning and welcome to the Sanlam Corporate Investments 2026 Quarter 2 Performance Update. I am Melissa Reddy, Senior Investment Specialist at Sanlam Corporate Investments. Before we jump into the presentation, I would like to take you through a few guidelines for this webinar. So your cameras and microphones have been disabled. You are welcome to send through your questions via the Q&A button in the toolbar. These will be addressed in the chat or we will send through responses after the session. A recording of this webinar will be made available to you post the event, and you can also find it on YouTube. Once the event is done, we will apply for CPD accreditation post the webinar. So I am joined today by Leonard Kruger, Equity and Multi-Asset Portfolio Manager with M&G Investments, who will give us an overview of markets and economics, followed by Thobela Mfeti, Senior Investment Specialist at Sanlam Corporate Investments, and Marion Gordon, Portfolio Manager from Sanlam Investments Multi-Manager. They will take us through the performance of the 4 accumulation portfolios in our Lifestage model. Finally, we have Dani van Zyl, Head of Smooth Bonus Center of Excellence at Sanlam Corporate Investments, who will cover the performance of the Capital Protection and the SUF Member Investment Choice portfolios. Without further delay, over to you, Leonard.
Thanks very much, Melissa, and good morning, everybody. Thank you very much for the opportunity to talk to you today, give you a brief overview of the economic overview of the second quarter, and maybe talk a bit about where we see opportunities and risks today in the market, and then hopefully leave you with a message of potential futures of what we might see and what we're looking out for in markets at the moment. So on the first slide, just a very brief introduction for those of you not familiar with M&G Investments. We were formerly known as Prudential Investment Managers, a name and brand that should be very familiar to everybody in South Africa. We've been in South Africa for over 30 years and part of the M&G Group, that's a London FTSE 100 listed asset manager, been in the business of managing clients' money for over 125 years. On this chart, you can see sort of our investment centers of excellence, so really well represented across the world, both from a US point of view, throughout Europe. Obviously, our investment center here in Cape Town, where we look after our South African and African clients, as well as in various positions of presence throughout Asia. Our business in South Africa looks after about 350 billion rands of AUM, and the larger group is a very formidable over 8 trillion rands of assets under management. So we really are a very substantial player, not just in South African terms, but actually in global terms. And we think that positions us as a business particularly well to make solutions and see portfolios holistically and build portfolios for clients using not just the local knowledge, but also using the expertise of our colleagues around the world to build exceptional outcomes and solutions for clients. So with that, if we look at an overview of the last quarter, and what I've done on this slide is just to try and simplistically illustrate to you just where we've been over the second quarter. So that would be the first panel on the left, and then a slightly longer perspective in the middle panel and on the right-hand panel. And then from the top to bottom, you actually see the various asset classes at a fairly high level of how they've actually performed over these respective time periods. So as most of you will know, 2026 is turning out to be a more difficult year from a returns point of view for South African asset owners, after we've experienced a very strong 2025, but actually a very robust recovery in assets really since the bottom of COVID in 2020. So let's look at the quarter first. And what you can see is that it's really been South African equities, when we exclude property, that has sort of been the hardest hit asset class from a South African point of view, despite the conflicts and the uncertainty that has arisen with the Middle East conflict and sort of the gyrations in things like the oil price. South African assets outside of equities have actually held up fairly well. So if you look at things like South African bonds, they returned 8% after they had an initial sell-off at the end of February, beginning of March. They've recovered very nicely. And a very interesting dynamic that has sort of played out this year, as well as in the context of the conflict that we've seen, has been the resilience of the South African rand. So the second from bottom, you can see there, the South African rand, just compared to the US dollar, strengthened by 4.2% over the second quarter. If we then turn to the other panels in the middle, looking at the past year or the past 3 years, a very, I think, often surprising feature for a lot of investors has been that if you look at the asset classes at the top, so whether that would be South African equities, South African property, or South African bonds, they have actually outperformed a very strong global market. So you can see over the 1 year as well as over the 3-year time period, even South African bonds and South African equities and then South African property has actually performed better than things like the S&P 500. And we often hear all the narratives around sort of the strength of things like the AI companies, which we'll talk a little bit in a short moment. But the South African assets have performed exceptionally well when you look at it and from a return point of view relative to that of opportunities in the rest of the world. The one asset class that has really struggled over all time periods, as you can see on this chart, has been global bonds. So that there are two factors there. One is you can see the South African rand that has actually strengthened over all of these time periods. So clearly when you're investing offshore and you translate that back into rands, that would be a hurdle on your returns. But what we've also seen is an increase in yields of international bonds. So the classic safe haven assets that people will typically flock to in times of uncertainty, like US Treasuries or US long bonds, they have increased a lot in terms of yield, and so you've seen a decline in price. The last observation that I'd just like to make looking at this chart is comparing these returns to South African inflation, which I illustrate at the very bottom line. So inflation rates have picked up because of the recent uncertainty and the impact that oil prices are having through the South African economy, but the inflation has remained fairly benign, certainly relative to our own history as a country, and certainly relative to what people might have expected. Now, when you compare this bar to the bars above that from the asset classes, you can see that the asset classes have returned significantly ahead of inflation. And so real returns for South African clients, whether you've been effectively in any kind of multi-asset balance fund or a more conservative low equity balance fund, you've really enjoyed very nice real returns over the past number of years from those kinds of portfolios. And that's clearly been a very welcome return after South African clients struggled for quite some time, really since even before COVID, where the returns were at times struggling to keep up with inflation. So very healthy returns, despite an environment that in 2026 has become clearly a lot trickier. If we go on to the next slide, I don't think anybody will contest that the news cycle remains extremely frenetic, and there's a lot of things happening all the time, whether we're looking at from a global point of view or more from a South African point of view, both in terms of economics, politics, and then also asset classes. So we at M&G don't try and forecast the future. We think that is firstly very difficult to do, and probably one that you'd have a low likelihood of being successful in. But we clearly need to be very cognizant of events, and throughout all the gyrations that the world can throw at you, stick to your process of being a long-term investor, being prudent in the way that we build our portfolios, and being aware of where the valuations for the respective asset classes are. So what I've done, or what I've tried to do on this chart, is to try and just highlight some of the main key points that are topical and relevant when thinking about building your portfolios today, and where the opportunities might lie. And what I've done, or I tried to do with the arrows that I show next to it, is just how these things have developed during the course of 2026. So red clearly being sort of a negative development, whereas green is sort of an improvement in the way things are going. Let's stay with the previous chart, please. So just to talk through some of these events, clearly it hasn't proven to be as difficult to end existing wars as some politicians have claimed, and in fact we are dealing with new challenges as we sit today. And I think Mark Carney, the Prime Minister from Canada, in early January in Davos, put it extremely well by saying the world's in the midst of a rupture, not a transition. And so a lot of the traditional relationships, whether that would be political, whether that would be economic classes, a lot of those traditional relationships and traditional safe havens or places where you would run to as a asset owner are being questioned by the markets and by investors. And so things like what I showed you on the previous chart, where the returns from bonds, for example, has been poor, runs quite contrary to what a lot of people would have traditionally expected in times of uncertainty, where you typically run to the US dollar, you'd run to US treasuries as your safe haven bets. What we've seen, no conversation about markets these days are complete without talking a little bit about AI and the huge impact that that's having both on investment markets, but also in the world at large. And so these narratives and eras of hysteria and fear are having a very material impact on markets. And so what we've seen so far, particularly in Q2, but the whole of 2025 and 2026 so far, has been an extreme concentration in market source of returns and specific companies. So whether we're talking about the Mag 7 or whether we're talking about the chip manufacturers or the memory players. So in Q2, for example, South Korea and Taiwan were some of the best performing stock markets because of their individual positions in companies like Taiwan Semiconductor, Samsung Electronics, or SK Hynix. And so the returns that we see on a asset class level look respectable, but it's been on an international scale been extremely concentrated and very difficult for active managers internationally to, if they were not positioned in some of these companies that are now very large in a portfolio context, to actually keep up with that. And so what you've seen during the month of July, for example, is that a lot of that extreme moves positive moves that you saw during Q2 in July has very brutally corrected, and a stock like SK Hynix has gone down almost 50% in South Korea in the space of less than a month. So really tricky market conditions in which we operate internationally. If we turn to the South African part of the equation, we really came into 2026 with a fair amount of constructive momentum in our economy, but really the oil shock from the Middle East events has really taken a lot of the wind out of our sails from an economic progress point of view. The big story of 2025 from a fixed income point of view was the new inflation target introduced by the South African Reserve Bank, and we were very well positioned to implement and adopt that framework in a pretty short space of time, opening up the possibility of lower interest rates. With the inflation shock, we've actually now seen the contrary, where the South African Reserve Bank actually had to increase rates as opposed to where the initial assessment would have been lower rates. Where things go from here very much depends on sort of how this conflict ultimately resolves or quietens down. When does the Strait of Hormuz actually open up again, oil flows, and what are the secondary impacts that flow through into the inflation rate and how other reserve banks respond. The South African Reserve Bank has been ahead of the curve in this cycle, having already raised rate, and that afforded them the opportunity in recent weeks to not follow again. Other real reform progress remains in the background of South Africa. So we were removed from the Financial Services Action Task Force last year. We've seen some credit upgrades, and we're seeing a very good development on the South African government finances, as well as tax collections in the year to date. Commodity prices have come down recently, particularly the commodity prices important to South Africa. Things like the platinum and gold prices that affect our trade balance, as well as then the higher oil price, which negatively affects our trade balance as we're an oil importer. So all of these things put together has really meant that we've moved sideways as opposed to moving upwards in terms of sort of really getting that economic engine and that flywheel for South Africa going. The last bullet point on this chart just talks to valuations then. And as I alluded to on the previous slide, the very good returns that we've seen in recent years has meant that valuations today are not quite as attractive as they were, say, in the preceding 1 year or 3 years. But generally speaking, we still believe that there are good opportunities for decent returns from South African assets. And so if we turn to the last slide that I've wanted to share with you this morning, it actually just tries to illustrate to you what we believe as M&G the potential after inflation returns per various asset classes are over the medium to long term. And what I've done, those are illustrated in the pink and in the blue bars, the real returns. And I've tried to compare that to where we were this time last year. And that's reflected in the green bars. Now, the other information that we have on this chart is to try and give you a sense of what the long-term returns have been from these respective asset classes. So if you look at something like equity, for example, you can see the yellow line there, the past 125 years since the founding of M&G, South African equities have returned about 7% ahead of inflation. We think fair value of what you need to expect as an investor is probably a little less than that, given the international companies that we have available in South Africa for investment purposes. And then we compare that to what we believe the returns available today are. And so you can see for South African equities, we think you can almost expect, given where valuations and profitability of companies are, you can expect something close to 9 to 10% after inflation from South African equities over the medium term. So generally what this picture then shows us is that the South African assets, which are portrayed on the left of the screen, left of the dotted line, typically are above our fair values, meaning there is opportunity for attractive returns. When we compare that to the returns on the right, which is the rest of the world, where you can see the valuations on average being much closer to where they are relative to fair value. Now, clearly, our colleagues overseas don't look at the world as a whole. They look like us at individual countries, individual asset classes. And of course, there will always be individual opportunities. And that's what we try and exploit when we then build a product like the M&G Balance Fund. So generally what you should expect from sort of our portfolios is we will have a greater tilt still to South African assets, given the positive return expectations that are not just higher relative to the rest of the world, but we think they're higher even after accounting for the additional risk that you need to take on for an emerging market like South African assets. And so we are constructive on South African bonds, we're constructive on South African equities, and given the recent moves that you've seen in global bonds, we have also been increasing our exposure to global bonds with the sell-off in yields. Thank you very much for your attention. I'll hand over to Bella to take you through her part of the presentation.
Thank you. Thank you so much, Leonard, for that market and economic update. My name is Thobela, and I will be taking you through some of the Lifestage strategies. But before I do that, let us look at the trustee-approved defaults. There are two different strategies within the trustee-approved default lineup. We've got the Lifestage strategies and the protection strategies. Within the Lifestage strategies, we've got four different, trustee-approved Lifestage strategies. We have the Sanlam Lifestage and the Sanlam Passive Lifestage strategies. Now, these two strategies follow a strategic asset allocation. And then we've got the Sanlam Blue Lifestage and the Wealth Creation. And these strategies, they follow a multi-manager approach. They follow a peer group approach. Now, what this means is that these strategies, their objective is to outperform the average balance fund out there. And the Sanlam Blue does this by using, the building blocks within the Sanlam stable. And now this also includes 91. I will take you through the Sanlam Blue and the Sanlam Passive. Marian will take you through the Sanlam Lifestage and the Wealth Creation portfolios. And now for investors that are concerned about significant short-term investments, if we can stay on that slide, for investors that are concerned about significant short-term investments, we've got protection strategies. Now, these protection strategies, their aim is to give you, inflation, real returns over medium to long term. And Danny will be taking you through, those protection strategies. Now, how does the Lifestage strategies work? There are two phases. Now, what you can see here, there are two phases. We've got the accumulation phase and the preservation phase. Now, in the accumulation phase, you will start by being invested in those portfolios that you are seeing here. So the four portfolios that we have mentioned. So you'll be invested in the respective accumulation phase portfolio for each strategy that you have chosen. Now, when you are 6 years before retirement, you will then be transitioned into the preservation phase of your savings. And that happens over 50 monthly switches into a preservation portfolio. And that preservation portfolio is the Sanlam Capital Protection Preservation Portfolio. And this is the same portfolio for all the strategies. So that means that, you will then 2 years before you retire, be 100% invested in this portfolio. There is nothing for you to do. So you don't need to remember this. This happens in the background as soon as you are 6 years before retirement. Now, let us take a look at then, the Sanlam Blue Lifestage strategy. Now, the Sanlam Blue Lifestage strategy is 50-50 split between the Sanlam Multi-Asset Growth Fund and the Sanlam Private Wealth Balanced Fund. However, I do want to highlight that as effective August, this portfolio will be 100% invested in the Multi-Asset Growth Fund, and this was a trustee-approved decision, which is currently in transition. But what you are seeing is, of course, the current split that we are showing to you right now, which is as at the June 30th. What is in front of you is, of course, the split, the portfolio split as at the 30th of June. This portfolio is managed to closely track, the allocation between these two managers. And what you are seeing on the right is the asset allocation, the combined asset allocation, which is a result, of the splits that you are seeing on the left. And what you are seeing here is, of course, the high allocation to growth assets. So we are talking about, the maximum allocation to equities currently that you are seeing in this portfolio. You are seeing an allocation to alternatives, which is a result of that Sanlam Private Wealth portfolio, which invests in alternatives, and you are also seeing some exposures to, of course, bonds, which makes up that portfolio. And if we move then to the next slide, what we are currently showing you here is the periodic returns over various periods. Given the long-term nature of this portfolio, we want to focus on the, on the longer-term returns. And what you can see there is, of course, this portfolio, does struggle a little bit, over the 10-year period, over the 3-year period. But if you are looking at the 5-year period and the 1-year period, you can see, the portfolio beating, outperforming its benchmark. And if you move on to the next slide, what we are now looking at is, of course, those individual portfolios that make up this, this Sanlam Blue portfolio. We're going to start by looking at the Sanlam Multi-Asset Growth Fund. And what you are seeing on the left is the asset allocation of this portfolio. And you can see, of course, that strong, allocation to equity is coming through. And you can see that the manager here, which is Paul, he's currently, max when it comes to, equities. And the reason for that is because, the manager is really constructive when it comes to equities. He sees value in equities. So there's a lot of value that he sees there. Equities are currently sitting above, 75, which is, of course, that regulation target. However, I do want you to be aware that the manager has 12 months to bring, this back to target. And given that the manager is still very constructive on equities, he is comfortable to keep this exposure and, and follow what the markets are currently leading him to. And what you are seeing then on the right is, of course, the performance of this portfolio. And you can see that over, the 1-year period, this portfolio has returned very strong, performance, currently at 15.2 versus its benchmark, which is the, the Alex Forbes Global Large Manager Watch, which returned about 13.8. So a very good portfolio, but also, very good returns that this portfolio is returning. And since inception, which is November 2024, you can see that the portfolio is currently outperforming its benchmark quite strongly. And that, and that trend is what you are also seeing, over the shorter term periods, even though, I'm not going to over highlight this because the focus is on the longer, on the longer term, periods. If we look at the next slide, now we take a look at the Sanlam Private Wealth portfolio, which is the half of, the Sanlam Blue portfolio. What you are seeing on the left is the asset allocation. As I've previously mentioned, you're seeing, alternatives coming through here. So that, this portfolio holds alternatives, which is different from the previous portfolio that I showed you, which doesn't hold alternatives. But however, also this portfolio, moderate aggressive, and it's currently, has a healthy allocation to growth assets as well. What you are seeing on the right is the, the returns of this portfolio, and you can see that over the longer term, it performed well. The 10 and 5-year periods, if you look at the 10 and the 5-year periods, currently outperforming its benchmark. However, if you look at the 3-year period, falling slightly, but of course, a recovery over the 1 year. And, and of course, the recent period, if you're looking at that 1 month there. So, of course, over the long term, giving you what it should, which is the outperformance over its benchmark. If we look at the strategic, if we look at the Sanlam Passive Lifestage portfolio, if we move to the next slide. Now, this portfolio, the underlying portfolio is the Satrix Enhanced Balance Tracker. Now, this portfolio is 100% invested in the Satrix Enhanced Balance Tracker. What you are seeing here is the strategic asset allocation of this portfolio. So as I previously mentioned, this portfolio is managed according to a strategic asset allocation. And what that strategic asset allocation is that benchmark. So what you are seeing here, the composite benchmark in green is the strategic asset allocation of this portfolio. What you are seeing in the blue is the current allocation of the portfolio. Now, this portfolio is a passive portfolio, right? So that means it invests in underlying indices, that track, these different asset classes. So SA equity, SA property, and bonds. However, there is a tactical asset allocation overlay in this portfolio, which allows you to eke out, the performance that you'll be seeing in the next few slides. What you can glean over here is, of course, that, the manager has taken a tactical view to be slightly overweight international equities and slightly underweight SA equities. And if we move over to the next slide, then we can see the performance and, what those tactical calls are currently giving you in terms of this performance. And you can see, the objective of this portfolio is, of course, track the performance of the benchmark, but you can see that it's giving you more than that, and that's because of those tactical calls that the manager is also able to implement. So you can see that over the longer term period, this portfolio giving you, a healthy outperformance when it is compared to that composite benchmark, and also you are experiencing that over the shorter term period as well. So, the tactical calls and the asset allocation coming through in this portfolio. What I will now do is to hand over to Marion to take you through the rest of the Lifestage strategies. Over to you, Marion.
Fantastic. Thank you so much, Thobela. Thobela took you through 2 of the Lifestage strategies. My job here today is to take you through the remaining 2, being the Sanlam Lifestage strategy and the Sanlam Wealth Creation strategy. So let's start off with Sanlam Lifestage. And within the strategy, what you'll see is that members are invested in the Sanlam Accumulation portfolio until 6 years before their retirement age. And so, as the name suggests here, what we are intending to do is really to provide members with capital growth over the longer term, really accumulating those assets for younger members within this particular strategy. It is a multi-managed investment solution. So what that means is that we blend skilled investment managers, but we also combine active and passive strategies to get exposure across various asset classes and markets, really to enhance that overall performance over the longer term. We are aiming here for a minimum return of CPI plus 5% over the longer term. And so naturally, this portfolio is geared toward capital growth type asset classes, the likes of property, the likes of equities, the likes of alternatives, as we'll see in the very next slide. So what you'll notice on this slide is the composite benchmark, which is really the strategic asset allocation. And the way to see this is really to see that as the long-term driver of your returns. And so strategically, we have a high weighting to equities. So if you look at South African and offshore equities, we're sitting from a strategic perspective at 68%. And then adding that to international infrastructure, which is also equities, you'll see that the total equity strategic exposure is 73%. But what you'll also note is at the moment, the portfolio is overweight all of those asset classes because we are so constructive on equities at the moment. Adding to that equity exposure, you'll also see a strategic weighting to property, both locally and offshore, of 7% in total. Again, taking the strategic weighting here of growth assets to 80%, really trying to eke out that investment return and outperform the long-term investment objective of CPI plus 5%. And the question is, has this done well? Has this blend of asset managers performed over the longer term? And so on the next slide, what we are showing is the investment performance on a trailing basis. And as you can see, despite a very small marginal underperformance of 0.3% over the last 1 year, during trending markets during the course of 2025, in particular, what you are seeing over the longer term is good outperformance of this very strong strategic benchmark, with a 10.3% return over the last decade, above our benchmark of 10.1%. We'll move on to the next and really the final life stage strategy that we'll discuss here today, which is the Sanlam Wealth Creation Life Stage strategy. Again, as the name suggests, this portfolio will have a high weighting to your equities, to your properties, to your alternatives, really to eke out additional outperformance and provide members with that wealth creation over the longer term. And so on the very next slide, what you'll see is the look-through asset allocation. What you'll note is that it's well diversified across various asset classes, both locally and globally, with again a large exposure to the growth asset classes, as I've mentioned. We are quite positive on equities from a tactical perspective, and so what you would also see here is that the total equity exposure, and that includes global infrastructure, is above the 75% regulation 28 limit. But as Tobela also mentioned on one of the other portfolios, we are quite positive on equity. So we're not in a rush to bring that below the 75% mark at this stage. We're actually quite comfortable sitting above that 75% level, given our view on equities, which was also supported in one of the earlier presentations. At the end of June, the portfolio had a total growth exposure of 85%. So really intending to provide members with that wealth creation over the longer term. Just taking a look at the next slide, what you'll see in this particular strategy is a blend of various different strategies. So we'll have multi-asset strategies here. These particular asset managers are able to allocate between various asset classes based on their tactical view. So you're really getting a good view of the manager's underlying positions within this particular portfolio. But we also have some strategic weightings, the likes of the alternatives building blocks, some passive equity exposure, and so forth, really intending to provide even greater levels of growth exposure. So it's well diversified. What you'll also note within this portfolio is that we have a great blend of skilled asset managers, and you'll see both your large established long-term asset managers that have been around for a very long time, but also your boutique managers that are incredibly skilled and have provided alpha and excess returns to members within this portfolio. And so on my very last slide, as I close off my part in this presentation today, again, you'll see a good long-term track record here. The Sanlam Wealth Creation portfolio's benchmark is the Alex Forbes Global Large Manager Watch, and that is really a peer group benchmark that is widely used within the investment industry. And over the last 5 years, you'll see on par with that peer group benchmark, but since inception, really providing a 50 basis points outperformance per annum relative to that benchmark, again, providing a healthy return per annum of 11% since inception. So that is it from my perspective, from my side. Both portfolios doing really well and really providing that capital growth to members. At this stage, I'll be handing over to Donnie van Zyl, who will take you through the rest of the presentation today. Over to you, Donnie.
Thank you very much, Marion. Good morning, everybody. Yeah, so I'll look at the portfolios that we use at the end of the lifestyle strategies, and also those 3 protection strategies that members can invest in, or funds can invest in, if they're worried about short-term volatility. Now, just to emphasize once again where all this fits in our life stage, as mentioned by Tobela, we have your aggressive portfolios. Doesn't matter which flavor you're invested in. And then when you get to 6 years for retirement, or 72 months for retirement, then we start switching you in 50 monthly switches to the capital protection portfolio. And it's actually only in the last 22 months that you're 100% invested in the capital protection portfolio. The reason we do that is to protect members' capital. Most members' retirement plans are not robust enough to survive a shock in the market crash just before retirement, and they can seriously upset their retirement plans and make them unable to achieve the retirement income they really need if they're not protected against that volatility just before retirement. Now, we like to think of our smooth bonus portfolios as our four-wheel drive vehicles. The reason I say that is the benefit of four-wheel drive is if you're driving over loose sand or gravel, anything like that, you have more traction even when the available grip is very low, and the backside of your vehicle doesn't swerve from one side to another that, creates panic and creates your heart palpitations. In the same way, the smooth bonus portfolios are there to provide really stable, predictable returns. Members can retire with confidence, knowing that their retirement fund value is protected, and they don't need to be worried about which country President Trump is going to bomb next just before retirement, and all those kind of uncertainty and shocks. Now, we not only smooth returns, that's the one part. The other part is we provide capital guarantees on benefit payment events. So this is normally where a person leaves their retirement fund. And these are non-selective events. So death, disability, resignation, retirement, retrenchment. And very important, the reason I mentioned it's non-selective or non-discretionary is you can't provide insurance against this event that the members can actually choose if they do it or not. And that makes it very difficult and unfair perhaps to the remaining members. So when we started with two-pot in September 2024, we were a bit cautious. We wanted to protect the remaining members in the portfolio, those who don't do a two-pot withdrawal. So initially we said no, a savings pot withdrawal is not a non-selective or non-discretionary event, and members will get the lower book and market value. Since then, we've analyzed our two-pot withdrawal experience, looked also at what our clients are telling us, and we decided to actually make a change. And from now on, I mentioned that during the Q1 webinar as well. In April, we made a change where we're now going to pay savings pot withdrawals also at book value. So members can have their certainty. They don't have to worry about portfolios being underfunded. So very important. We smooth investment returns, and the value members see on the statement is also the value they'll get from a two-pot withdrawal. I think makes life and communication to members a lot easier. Now focusing specifically on the capital protection portfolio. As I mentioned, this is the one used at the end of our Lifestage model. It is a more moderate portfolio underlying. If you look at the actual strategic asset allocation, whereas the four portfolios that both Marion and Tobela showed had about 70 or even sometimes more than 75% exposure to equity. If you add the local international equity here together, it's around 50% of the portfolio. So far more moderate profile of the portfolio, wide distribution and of course all different asset classes. And I thought I'd just highlight there, for example, if you look at the SA property, that's the bulk of it is direct property, so you own the physical bricks and mortars. If you're with me here in Durbanville, then the Durbanville Village Square is one of the newer properties in the portfolio, doing quite well for us. We've also done some developments there by the Newlands Cricket Club. There's some office developments there, so that's moving into the portfolio. And at the same time, to renew the portfolio as well, we do sometimes sell, a portion or, a whole property. And in KZN, for example, during last year, we sold half of the Chatsworth Centre to other developer. And that's just one way we keep on, renewing the portfolio to make sure it actually achieves what it's supposed to achieve. Also, just during a recent asset allocation change, we've decided to allocate to international listed infrastructure, reducing our exposure to international bonds. Now, I think the team from M&G explained quite nicely why international bonds are not that attractive at the moment, and we do believe it will add a bit more diversification to the portfolio. Now, many of you will remember from our previous presentations that 91 has taken over our active manager. So in my case, that means that the SA equity, SA nominal bonds, and SA inflation bonds are all now managed by the teams at 91. It's actually still the same people who moved from Sanlam Investments to 91, but those are now managed by 91, whereas the rest of the assets are still managed in-house by Sanlam Investments. Now, if we can just look at the returns. Once again, as I mentioned, this is a more moderate portfolio, but still we're very pleased with returns, especially over the short term. You can see there the graph, the gross bonuses versus inflation plus 3.5. So the portfolio did 12.3% over the last year, which I think compares quite favorably with some of the Lifestage accumulation strategies. I mean, both the blue strategy and wealth creation strategy returned about 14.3 or 14.5%. So 12.3% for more conservative options, actually very good going. If you just look at the table at the bottom there, we show the returns, the real returns and above inflation. So over 1 year, the portfolio is given inflation plus 7.8, which is a very high return. And I don't think that's sustainable from a very conservative or a more moderate portfolio. I think clients might need to temper the expectations going forward. If I look more at the longer term results, 5 years and 10 years, where returns have been inflation plus 4.9 or inflation plus 4%, that's more what we expect from this portfolio over the very long term. Now, then turning to the 3 protection strategies, as mentioned earlier by Tobela, we have the Sanlam Secure strategy, which is our most conservative or portfolio with the hardest guarantee. It's 100% invested in a monthly bonus fund, which is a portfolio where we declare bonuses, but bonuses are fully vesting. We can never take anything away there. Then we have the Sanlam Stable strategy, invested on a stable bonus portfolio. Now, incidentally, this is exactly the same portfolio we use in the capital protection strategy. So these two are identical. We declare monthly bonuses, half of which is vesting, half non-vesting. If things are really, really bad, then we can remove some of the non-vested bonuses. Clients can see a small negative return, but we've never done so since we launched this portfolio in 1986. So it needs to be a really serious market crash before we do anything like that. So I think perhaps the credit crisis in 2008 and COVID put together, if you give you an example, it needs to be a really serious event before members see a negative return there. And then lastly, we have the volatility protection strategy. Now, this is a very different type of portfolio. Here, the trustees of the Umbrella Fund decided to put 2 different portfolios together to focus purely on reducing volatility and not so much on protecting capital. So it is 75% invested in a monthly bonus fund and 25% in a Satrix Enhanced Balance Tracker Fund. So that extra 25% from a Satrix portfolio provides additional returns when markets are doing well, but also it reduces the fact that you can have occasional negative returns over the short term. So there's no capital protection in the volatility protection strategy, but it has a focus on actually reducing volatility, as the name suggests. Now, looking at these strategies in more detail, we're going to start off with the Sanlam Secure strategy. As I mentioned, our most conservative one. And if you just look at bonuses versus CPI, the portfolio is managed very similar to the capital protection portfolio, but has a high guarantee fee, so therefore slightly lower returns. And you can see that 11.3% gross over 1 year period. Once again, in the bottom there, we show you the real returns. So that's how much returns have exceeded inflation. So over 1 year, inflation plus 6.8%, 5 years, inflation plus 4, and 10 years, inflation plus 3.3. Once again, I think the 1 year figures very much inflated due to the very good equity returns we've had over the last while. The 5 and 10 year returns should give a better indication of what we expect from this portfolio in the very long term. Then we turn to the Sanlam Stable strategy. As I mentioned, this is exactly the same portfolio we use underlying in strategy. So exactly the same returns. Everything that I mentioned there applies here as well. So once again, look at the 5 and 10 year returns, and that'll give a good indication of what to expect going forward. Volatility protection is something, as mentioned, something different. We combine 2 very different portfolios together. So if you actually look at the asset allocation there, we have 75 in monthly bonus, 25 in Satrix. And if you look at a combined asset allocation, this can vary over time a little bit more, and it's a bit more aggressive than any of the smooth bonus portfolios on its own. So the total equity there could be higher than 50% if we add them together. And the Satrix portfolio do have a bit more wiggle room to move around in. So you can see the equity performance there varying quite a bit. It'll generally be a bit more than 50%, so more than the smooth bonus portfolios on their own. So where we are at the moment, I mentioned we aim for 75 in a monthly bonus, 25% in the Satrix portfolio. Now, our manager have the ability to, they don't need to trade exactly, keep it at that. They have a ranges they can operate within. So normally we see the monthly bonus funds part ranging between 73 to about 77%. At the moment, it's about 75.6% of the total portfolio. And that's just to reduce the amount of trading they need to do. Over 1 year, done 13.1%. So the Satrix component has added value compared to the monthly bonus fund on its own. But over 1 month period, it's also detracted. We know markets have been up and down. So this is a portfolio where the Satrix component can add additional returns, but it can also lead to occasional negative returns over 1 month, even 3 months. We have never seen, though, very long-term negative returns from the added passive component we have added into this portfolio. So then what we can look for next is just your member choice portfolios. We have a wide range of portfolios that members can invest in. You can just see on screen, so we have the conservative portfolios, moderate, and then especially on the moderate and aggressive side, it's a big range, and there we have a number of external managers in there as well. So for example, we have Denker and Voort and Coronation and M&G and PSG. So we do like to invite some of these managers every now and then to come and take part in our quarterly reports. Today was a turn of the M&G team. They're one of the portfolios, obviously you can see there, and we will be asking some of the other managers also to take part in some of these webinars. I do want to highlight that during September last year, we've added 2 portfolios in there, the Satrix Global Achiever Fund and also the Denker Balance Fund. So they've been in the member choice, and members can allocate to those portfolios. Also, as Tobela has mentioned, we are making some further, or the trustees are making some further changes. They will be removing the SVW Balance Fund on August, so members will no longer have the opportunity to allocate to that portfolio going forward. Now, let's move forward and look at some of the investment returns. Now, unfortunately, I'm in my 50s, so I need to squint a little bit to see all these portfolios. There's quite a number of them, but you'll notice they, especially on a one-year side, there can be a far more a bigger dispersion of returns between the different managers. They have different styles and different ways of constructing portfolio. But we can see that PSG has been actually quite good at maintaining a high performance over 1, 3, and 5 years. And in fact, after COVID, they've done particularly well. Then we have the Satrix portfolios there and the Sanlam Accumulation. You can see all of them quite high up on the performance charts there over 1, 3, and 5 years. More to the middle, you have Allan Gray and M&G. And then you can see on the bottom side, Voort has disappointed, I think, a bit over the 1, 3, and 5 year returns. So they are lagging behind the other portfolios over all that period. But we do know that Voort can be quite volatile from time to time as well. And that's something I think the members need to be quite aware of when they do decide to allocate to that manager. I want to just emphasize there the Living Planet Fund. That's one of the portfolios in there. So that's a portfolio with a very much sustainability focus. They wouldn't, for example, invest in Eskom bonds or any, coal-fired, energy producers. They wouldn't invest in mining stocks. So therefore, especially you see the Sanlam Living Planet Fund during periods like over a 3-year period when resources have actually done quite well, you do expect that portfolio to actually lag, but it has come, it has improved over the 1-year period. But that portfolio will definitely have a very different return profile from the others you see on the screen. Then looking a bit more at the moderate portfolios we have, bit of a shorter list there. You can see the NUR portfolio doing specifically well. Now, I'm going to just explain the NUR and the Temperance Balance Fund a little bit more because people do sometimes get a bit confused between the two. So our NUR Balance Fund is our Sharia compliant portfolio. So those members who want to invest in a Sharia compliant portfolio, that, for example, you don't have alcohol in there, you don't have companies that get a lot of the income from interest, so very low on financial services. So that's really what that portfolio is trying to achieve. Often we find that portfolio having a bit more towards resources than some of the other balance funds because to compensate for the fact that they will be underweight financials. Now, the Temperance Balance Fund is slightly different. This was a portfolio used by one of our big church groups in the country. And when they moved into the Sanlam Umbrella Fund, we decided to make that available on the member investment platform. Now, the Temperance Balance Fund is a big focus on not having invested in sin stocks. So there they have, for example, no alcohol, no tobacco, no adult entertainment, no gambling, all those kind of things. And the name Temperance is a balance is just a nod to the temperance movement we saw in the 1920s in the USA that led to the Prohibition Act and a limited amount of alcohol that can be sold. So the Temperance Balance Fund and NUR, a bit different. Neither of them have alcohol in, but there are other exclusions as well, which means that the return profile you'll see from that portfolios will be different as well. But as the Temperance Balance Fund has actually done quite well over the 3 and 5 years. And then lastly, if we look at the conservative portfolios, here we have the portfolios where we smooth returns and also the ones with guarantees, and also the SMM30 portfolios. So SMM30, the 30 in there refers to the 30% allocation towards equity. So these portfolios won't do as well when markets are running, but once again, they come to their fall when markets are doing poorly, and a really limited amount of time members will see a negative return. So this brings me to the end of all those portfolios. thank you very much. It's also the end of our webinar, and I do want to just reaffirm a couple of things. So remember that any questions that you had in the chat that wasn't answered during the presentation, we will answer some of them later. There will also be a copy of the presentation available. It will be emailed to everybody, also be available online. We will be applying for CPD points. I know many of you will need CPD like myself, so it's always very useful to get this additional CPD points. And then thank you very much. I hope you found this worthwhile and informative, and we'd like to see you guys again at our Q3 webinar. Thank you, everybody.